My name is Sarah. I'm 33 years old, and until recently, I thought my marriage was stable. Not perfect, but stable enough to last. That belief ended the night my husband looked at me across our kitchen table and said something I never expected to hear. "You know something, Sarah," he said calmly, like he was commenting on the weather. "You're replaceable." At first, I thought I misunderstood him. The word sounded strange coming from his mouth. Replaceable. I laughed a little, waiting for him to say he was joking, but he didn't laugh back. Instead, he leaned back in his chair, folded his arms, and repeated it more slowly. "Everyone's replaceable," he said, "including you." The room suddenly felt very quiet. The only sound was the low humming of our refrigerator and the ticking clock on the wall. I stared at him, trying to understand if this was some kind of argument I had missed. But we hadn't even been fighting, we were just eating dinner. And yet, in that moment, something about the way he said those words felt different, cold, calculated, almost like he had been thinking about it for a long time. Before I tell you what happened next, make sure to like the video and tell me in the comments where you're watching from. I'm always curious to see where these stories reach. Now, let me explain how everything started to fall apart. My husband's name is Daniel. We met almost 9 years ago at a friend's birthday party. Back then, he was charming in a quiet way, the kind of person who didn't talk much, but when he did, everyone listened. He worked in corporate sales, and he was very ambitious. At first, I admired that about him. I worked as a school counselor. My job wasn't glamorous, but it meant something to me. I spent my days helping teenagers navigate problems most adults didn't even understand. Daniel used to say he respected that, but looking back now, I'm not sure he ever really did. The change started slowly, small comments at first, the kind that don't seem serious until you notice how often they happen. Like when we were at dinner with his coworkers last year, one of them asked what I did for a living. Before I could answer, Daniel laughed lightly and said, "She just talks to kids all day." Everyone chuckled. I smiled politely, but something about the word "just" stayed with me. Later that night, I mentioned it to him. He shrugged. "I didn't mean anything by it," he said. "Relax." So I did, or at least I tried to. But over the next few months, the comments kept happening. If I talked about work, he would barely listen. If I mentioned a student I helped, he would nod distractedly while scrolling through his phone. One evening, after I finished telling him about a difficult situation at school, he sighed and said something that made me pause. "You care too much about other people's problems," he said. "That's why you're stuck where you are." I didn't answer right away. Instead, I just stared at him for a moment, trying to decide whether he meant that as advice or criticism. But he had already changed the subject. Looking back now, that was probably the first real sign that something inside our marriage had shifted. But at the time, I ignored it, because ignoring problems is often easier than confronting them. Our house was small but comfortable. We had bought it together 5 years earlier. A quiet street, a small backyard, and a kitchen that always smelled faintly like coffee in the mornings. From the outside, our life probably looked normal, but inside the house, something had started to feel uneven. Daniel's career was taking off. Promotions, bonuses, expensive work trips, and with each success, he seemed to change a little more. More confident, more impatient, more dismissive. One evening, while we were getting ready for a company event he had invited me to, he looked at me in the mirror while adjusting his tie. "You're wearing that?" he asked. I looked down at my dress. It was simple, navy blue, something I had worn to formal dinners before. "Yes," I said carefully. He hesitated before answering. "I just thought maybe you'd want something nicer." The way he said it wasn't loud, but it carried a quiet judgment that made my chest tighten. Still, I didn't argue. I simply nodded and said, "It's fine." But that night at the event, something happened that I couldn't ignore. Daniel introduced me to a group of his colleagues near the bar. They were all laughing and talking about some business deal they had just closed. When one of the women asked how long we had been married, Daniel smiled and said something that made my stomach drop. Long enough to know people can always be upgraded. Everyone laughed, including him. At first, I tried to laugh too, but then he looked directly at me and added something else, something quieter, something meant only for me to hear. "Don't worry," he said under his breath, "I'm not shopping yet." That was the first moment I realized something was seriously wrong. But I still didn't expect what would happen a few weeks later, because the night he called me replaceable was the same night I discovered he had already started looking for my replacement, and what I did next was something he never saw coming. The moment Daniel said the word replaceable, I didn't react the way he probably expected. I didn't yell, I didn't cry, and I didn't argue. Instead, I just looked at him quietly. For a few seconds, neither of us said anything. The kitchen lights were bright, reflecting off the glass table between us. His plate was half empty. That is one of the largest accumulation cycles in modern financial history, and they are not doing it slowly anymore. Countries across Asia and the Middle East have been increasing gold allocations while simultaneously reducing their exposure to U.S. treasuries. That shift doesn't happen randomly. Central banks do not buy gold because they expect a short-term price rally. They buy gold when they begin preparing for a different type of monetary environment. Now, layer the second reality on top of that, the structural side of the dollar itself. The United States currently carries more than $34 trillion in national debt. Interest payments alone are beginning to approach levels historically associated with wartime financing. And here is where the math becomes difficult. Every time interest rates rise, the cost of servicing that debt rises with it. But if rates fall too quickly, the dollar weakens and inflation risks returning. That tension creates a narrow path for policymakers, a path that markets are beginning to watch very closely. Now look at the gold market again through that lens. Gold doesn't produce cash flow. It doesn't pay dividends. It doesn't generate yield. And yet global demand for physical gold has been rising steadily. Why? Because gold performs a very specific role in financial systems. It sits outside them. Gold doesn't rely on a government's balance sheet. It doesn't depend on a central bank's credibility. It simply exists as a reserve asset that has survived every monetary regime in modern history, which is why what's happening now deserves attention, because we are starting to see signals that institutional buyers may be preparing for something larger than a short-term economic cycle. Let me show you the numbers that make the situation more interesting. In the past 12 months, gold has recorded multiple new record highs. At the same time, the dollar index has remained historically strong compared to most global currencies. That combination rarely lasts. Normally, one of those assets eventually gives way. Either the dollar weakens and gold accelerates, or gold pulls back as the dollar maintains dominance. But if both remain elevated at the same time, it suggests global capital may be hedging against something deeper, something structural, something that doesn't resolve with a single rate cut or a single economic report. Now, before we take that conclusion too far, there is a resistance case that needs to be addressed, because ignoring the skeptical perspective would make this analysis incomplete.
Gold rallies often occur during periods of geopolitical tension or financial uncertainty, and those rallies sometimes reverse quickly once conditions stabilize. Additionally, large institutional funds still hold massive allocations in dollar-denominated assets. U.S. Treasury markets remain the deepest and most liquid bond markets in the world, which means the dollar's position in global finance is not something that disappears overnight. Markets can show early warning signals long before structural changes actually occur. So the current divergence between gold and the dollar could still resolve itself through normal market mechanics. That possibility needs to remain on the table. But here is the reason analysts are watching this moment more closely than usual. Because beneath the surface of the currency system, another trend is quietly accelerating. Central banks are buying gold at the fastest pace in decades. Emerging economies are reducing their reliance on dollar settlement for trade, and physical gold flows between global exchanges are increasing in volume. Individually, each of those trends might not mean much. Together, they begin to look like early positioning for a financial environment where gold's role inside the system becomes more important again. And if that shift continues, then the next move in gold may not just be a commodity rally, it could be a signal that global capital is beginning to hedge against the long-term trajectory of the dollar itself. So here's the question I want you to think about before markets open tomorrow. If central banks continue buying gold, if global demand for physical reserves keeps rising, and if gold continues climbing even while the dollar holds strength, then what exactly is the market preparing for? Because if you step back and look at the broader structure of the global financial system, gold and the dollar are not just two assets moving on a chart. They are two different types of monetary anchors. The dollar is a currency backed by the credibility of the United States economy, its institutions, and the depth of its financial markets. Gold, on the other hand, is something much older. It doesn't depend on policy, it doesn't rely on interest rates, and it doesn't require trust in a government balance sheet. For thousands of years, gold has functioned as the asset nations fall back on when monetary systems begin to evolve. Not collapse, evolve. That distinction matters, because major financial transitions rarely happen through sudden breakdowns. They happen through slow adjustments. Reserve allocations shift, trade settlement mechanisms change, central banks rebalance their holdings. And then, years later, historians look back and realize the shift started much earlier than anyone recognized at the time. Now let's look at the next layer of the data.
Over the past decade, central banks have steadily increased the percentage of gold inside their reserve portfolios. Countries that historically held the majority of their reserves in dollars are now diversifying, not abandoning the dollar, diversifying away from complete dependence on it. China has increased its official gold reserves several times over the past few years. Russia accelerated gold accumulation long before recent geopolitical tensions escalated, and multiple emerging economies have begun quietly following the same pattern. That alone doesn't overturn the dollar system, but it does indicate preparation, because central banks don't make dramatic portfolio shifts based on short-term market expectations. They make them based on long-term strategic positioning. Now look at another signal that has appeared in recent months. Physical gold demand from Asia and the Middle East has been rising even during periods when Western investment demand slowed. Normally, those two regions move somewhat together, but lately there have been moments when Western futures markets cooled while physical buying in other regions intensified. That divergence matters because futures markets often reflect short-term positioning by institutional traders. Physical buying tends to reflect long-term accumulation, and when long-term accumulation rises during periods of financial uncertainty, it usually means buyers are thinking in multi-year horizons, not quarterly returns. Now bring the dollar back into the picture. The dollar remains the dominant reserve currency for global trade. Roughly 80% of international transactions are still conducted in dollars. Energy markets, commodities, and global financing systems all remain heavily tied to dollar liquidity. That structure doesn't disappear easily, but systems this large do slowly adapt when incentives begin to change. For example, several large economies have recently explored bilateral trade agreements that bypass dollar settlement entirely. Instead of converting through the dollar, they settle trade directly in their own currencies or through commodity-linked agreements. Those agreements are still small relative to global trade, but they are increasing. And when multiple countries begin experimenting with alternative settlement structures at the same time, analysts start asking a different question. Not whether the dollar disappears, but whether the dollar's dominance gradually declines over decades. If that process unfolds slowly, gold naturally becomes more important, not as a replacement currency, but as a neutral reserve asset sitting between competing monetary systems. And that brings us back to the data we started with. Gold rising even while the dollar remains strong. Because if capital is preparing for a world where multiple reserve currencies coexist, then holding gold becomes logical. Gold doesn't belong to any single country. It doesn't depend on the stability of one economy.
It functions as a universal reserve asset that every nation recognizes, which is exactly why central banks continue accumulating it. Now, here is the final signal I want to leave you with. Global gold production has not dramatically increased in recent years. Mining output grows slowly. Permitting takes years. New deposits take decades to develop. That means supply expands far more slowly than demand can shift. If central banks, institutional investors, and private holders all begin increasing allocations simultaneously, the available supply doesn't immediately adjust. Prices adjust instead. That dynamic has played out multiple times throughout financial history, and every time gold entered a new structural phase, the early signals looked very similar to what we are beginning to see now. Gold rising quietly,
central banks accumulating, the dollar remaining strong, but facing long-term questions about debt sustainability and global settlement structures. None of this guarantees an immediate surge in gold prices. Markets rarely move in straight lines. Corrections happen, momentum shifts, but structural transitions often begin long before they become obvious, and the data emerging right now suggests we may be entering the early stages of one of those transitions. So here's the final question I want you to sit with. If central banks continue accumulating gold, if global trade slowly diversifies away from single currency settlement, and if investors begin treating gold not as a commodity but as a strategic reserve asset again, then the next major move in gold may not just reflect market sentiment. It may reflect a deeper adjustment in how the global monetary system is structured. And if that adjustment accelerates, then the next move in gold could do something markets haven't seen in a long time. It could begin moving independently of the dollar entirely. If this analysis gave you a clearer view of what might be unfolding beneath the surface of the global financial system, you know what to do. Share it with someone who watches the markets closely. Subscribe if you want more breakdowns like this when the data shifts. And if you're still here at the end of this analysis, drop gold data in the comments. Not as a trend, as a signal. Because the people who stay to the end of conversations like this are usually the ones paying attention when the system starts to move. Be smart, follow the data, protect your position, and remember one thing: markets don't lie, but they rarely explain themselves either.